In the trading contest, there are 4 mandatory strategies that you will need to do in order to meet the requirements for this contest. Remember, having the highest return will not be enough to win the contest. You will also need to execute all 4 mandatory strategies. Let's begin. The next mandatory strategy is the Condor Call. A long call condor consists of 4 call options with the same expiration. The strategy is constructed of 1 long in the money call, 1 short higher middle strike in the money call, 1 short middle out of the money call, and 1 long higher strike out of the money call. This is a combination of a bull call spread and a bear call spread. Since the Condor Call is a bull call spread and a bear call spread together, the trader will need to put up 4 legs. Long and in the money call, and short and in the money call with a higher strike price. Short and out of the money call, and long and out of the money call with a higher strike price. The trader's outlook is expecting little or no price movement in the underlying stock. The ratio is 1 contract for each leg for all 4 legs of the strategy. The maximum reward is the lowest short call strike minus the lowest long call strike minus the net premium paid. The maximum risk of this strategy is limited to the net premium paid. There are 2 break-even points with this strategy. The lower break-even point is the lowest long call strike plus the net premium paid, and the upper break-even point is the highest long call strike minus the net premium paid. The Condor Call's payoff diagram will have 4 strike prices, A, B, C, and D. The short calls are points B and C, and the long calls are points A and D. If the stock price is greater than the highest strike of the 4 calls, then all the call options will be exercised and offset each other for a 0 profit. If the stock price is below the lowest strike price, then all the options will be all worthless. If the cases mentioned above occur, then you will lose the premium paid for this strategy. Ideally, the underlying price would stay between the 2 break-even points. The 2 break-even points are illustrated by the red dots. The profit zone is between the 2 break-even points, and the risk is limited to the net premium paid. Let's do a Condor Call example on Canadian Pacific Railway, ticker symbol CP. Using the example that CP is trading at $211, you would buy the $195 call for $17.75. Sell the $205 call for $9.50. Sell the $215 call for $3.90. And buy the $225 call for $1.30. All legs together is a net premium paid of $5.65. In the risk analysis, the cost is $565. This amount is also the trader's maximum risk. The maximum reward is $435. The probability of profit is 46.9%. The 2 break-even points are $200.65 and $219.35. For this trade to be profitable, the stock price needs to be between these 2 break-even points. If the stock price does remain between the 2 break-even points, the maximum profit that the trader can make is $435. The payoff table for a Condor Call may look overwhelming due to the number of legs, but there are many position simulators or customized spreadsheets that can help you automate this task. The break-even points are $200.65 and $219.35. At this price level, the trader will make a profit, but it won't be sufficient enough to cover the cost of the strategy. The trader will want the share price to be between the 2 strikes of the short calls. If this happens, then the trader's profit will be at its maximum. If the trade goes below $195 or above $225, then the trader's strategy will turn into a loss with a limited risk of $565. Thank you. If you have any questions, please contact us at contestadmin@tmx.com.